behind the scenes, it was a small group of people that were doing everything.
Welcome back to the GTM podcast. It's your host, Scott Barker.
I want to know how this insane growth actually happened.
Hello and welcome back, everyone, to the GTM podcast. You've got Scott Barker here. I appreciate all the support lately. It's always cool when the listener numbers are up and to the right. So thank you for hanging out. Thanks for using this as a tool to help scale your careers and your companies. Certainly, we do our best to bring on incredible guests, CEOs, operators, founders who are living the experience that you're living if you're listening to this podcast. And you're likely responsible for driving revenue at your organization, and try and speak through stories, give you actionable tips, tricks that will help you in your career and grow your business. This will be a fun one. We're going to talk about some topics that I'm super personally passionate about, but I'm joined by Bob Moore. Bob, welcome, man.
Hey, it's great to be here. Long time coming. Scott and I have known each other for quite a while. I think it's a first time, long time situation. So flattered to be here. Excited to chat.
Yeah, man. I was looking as doing some prep for this. Crossbeam has almost been around now for 6 years. Is that right?
Yeah, that is right. We started. We launched in early 2019, but there was kind of a incubation period in 2018 where we were kicking the tires and putting things together. So that's like our real formation date. Yeah.
Yeah. So cool. I can still remember when I first heard of Crossbeam, and I was like, how does that not exist? I was living in that partnerships world at the time, and it's so cool to see the scale now. I know tons of happy customers, and we're excited to play a small part at GTM Fund and now GTM now. But for the listeners, I also always like to just tee up a quick bio, because it is a super impressive one. So Bob Moore is the co-founder and CEO of Crossbeam. If you haven't heard of Crossbeam, it is an ecosystem-led growth platform. All right, it's going to help companies use their partner ecosystem to generate leads, close deals, and grow faster. Being in the partnerships world myself, I think for many years, there was this huge gap between signing a new partner, making a bunch of noise about the announcement, and then fizzle. There was no action, there was no outcome coming. And we'll get to that a little bit later, but that's a big part of what Crossbeam is solve is actually enabling your partners to drive revenue. But previous to that, you co-founded the cloud data pipeline company called Stitch, which was acquired by Talend in 2018. Before that, a business intelligence platform, RJMetrics, which was acquired by just a small company called Adobe by way of Magento. And then prior to that, which I didn't actually know until I looked at your background today, you were at Insight Partners, which we love. How long were you at Insight?
I was there for 2 years, from 06 to 08.
Nice. We love the team at Insight. I was actually just on with their team yesterday. We share a couple of portfolio companies. Great firm. So they're a venture and PE firm out of New York. Also a graduate of Princeton University, School of Engineering and Applied Science. Proud to be a Philadelphian, which is cool. I actually spent some time in Philly for my first time, and I loved it. Do you know Chris Donato by any chance?
Oh, I don't think wait a minute. What's he do? That name is familiar, but I obviously don't know him closely.
Yeah. Not that everyone in Philly knows each other, but he is in our world. So Chris Donato runs eSalus, which is a great enterprise sales services company that is now building some technology. He's also the enterprise chair of the Pavilion chapter. So you might know him through that as well.
That's probably where I know him. Yeah.
Should connect with him. He's a great dude. But yeah, and then, outside of all of that, you are a writer, a speaker. You've been in New York Times, Forbes, TechCrunch, VentureBeat, TEDx, all the places. And one of the cool things that I thought was you're also an improv comedy performer. Do you still find time to do that?
In the post-pandemic era, it's been weird, I'll be honest with you, because there was a period there pre-pandemic where it was my number one outside of work hobby. I was on a house team at the Philly Improv Theater for 5 years. We performed weekly. So got a lot of reps in during that era. And then COVID was, obviously terrible for the live theater industry. And we kind of saw a lot of improv theaters and small kind of, regional and community theaters go under or really struggle or have to redesign themselves. So there was a period in time where there was a lot of like Zoom improv going on, which like, let's be real, normal improv is terrible. Zoom improv is like a whole other level of like unbearably bad. So it's been fun. The improv scene is finally, starting to like pop its head up again. There are some newer theaters emerging in Philly. I've done a couple of shows, a couple of festival shows, and a couple of just like ad hoc like reunion shows with my team, but I haven't been on a steady drumbeat of it since 2020 really. But so many, I could talk for an hour about just like the ways that experience bleeds its way into leadership styles and collaboration styles and all the various things you kind of need to figure out if you don't want to screw up building a company. So I'm a big supporter of anybody whoever wants to go explore improv to just like have it be a channel for personal growth. I think it's awesome. I'm a huge fan.
Yeah, I love it. Yeah, I mean, like we're all as a founder, I think you're just doing improv with bigger stakes on the day to day.
Yeah, anyone who thinks they're not doing improv while starting companies is lying to themselves. Yeah,
Yeah, I love it. That's cool. Well, would love to check out a show one day. That would be super fun. But let's dive right in. There's a lot I want to cover. I think we'll kick off with kind of more of a general macro conversation on just where we're at in this weird market, what you're seeing. You have a great lens as an investor and a founder. Want to spend a decent amount of time talking about ecosystem-led growth. And then, of course, this is a story-based podcast. So you actually made a $2.6 billion mistake in your career, which is big. So we'll get to that. But let's talk about, the general SaaS space right now. And when you look at macro trends, when you look at, Crossbeam and the growth you've had, when you look at customers, what's going on? Are things getting better? Because please just tell me they're getting better.
All right.
Lie to me if you have
I'm
to.
optimistic. I'll put it that way. There's this really interesting thing that I think it doesn't get discussed too often when people talk about the industry and the trajectory of interest rates and kind of the ripple effects to valuations and to capital efficiency priorities and things like that, which is SaaS in particular, and especially enterprise SaaS, has this very interesting like time delay to the pain that gets experienced where, if you sign a contract on January 1st and then that customer does a layoff on January 2nd, you don't actually experience the pain of that renewal compressing or that churn happening or whatever it is that has changed fundamentally in how that customer operates. Your financials, your NRR numbers, your churn, your expansion don't take the hit for 364 days. And even if in those 364 days, maybe you've added a lot of other customers or things are going great in your business or, relative to the market, you're overperforming, there is still this very interesting, cohort effect that happens where there is kind of a long, like a power law curve of pain that SaaS companies need to swallow as an after effect, as a shock wave of actual market and macro effects that bring that pain on. So I think a lot of where there's this very interesting crosswinds right now in a lot of businesses where the reality is like the NASDAQ has been ripping and performing. Earnings have been coming in really strongly. I think a lot of the really hard changes companies have needed to make around kind of right sizing their teams and refocusing their strategy around efficiency and returns for shareholders. That work was done, and in a lot of cases done very, very shrewdly and very well in late 22, early 23. And yet in many SaaS companies, it still kind of felt like, yeesh, like Q4 still doesn't quite feel like we're back to some ideal world and this is what we want our company to look like forever. But there's some very interesting kind of like light peeking through, right? Like maybe new sales have picked up. Maybe there's interesting acceleration and expansion. Maybe it seems like our customers actually started hiring again and teams are growing and new seats are getting turned on and like usage numbers are back up. And like what I will say is that the reason I'm optimistic is because in my view, the lagging indicators are the ones that look bad and the leading indicators are the ones that look good. And when you see that, that is a great time to start investing and, having some level of confidence around it being a buying moment. And look, if it was in the stock market, you missed your window maybe, right? Like that buying moment was probably 9 months ago or something, when a lot of these SaaS stocks were kind of at the bottom of their curves. But I think it's a moment where the good and the bad of that is that no one gets to hide behind the market anymore. I think there's going to be a general expectation in the coming year of relative overperformance compared to 2023, because there are rising tides, right? And look, the tide went out. It doesn't mean the rising tide is going to rise up to be higher than where it was. I'd be terrified if we ever got back to 2020 or 2020. Like it would require another like black swan level terrible event to take place impacting our economy that would drive the Fed to move interest rates to 0%. Like if interest rates get that low again, there's something else really bad going on. I don't want to go there. Where I'd like to get to is a place where the volatility in how those rates go up and go down stabilizes. And I think that's what we thankfully have been getting a little bit of telegraphing of from the Fed. And that leads to confidence in markets and having some sense of where we're going to end the year interest rates wise rather than begin it, which means people start allocating capital accordingly. And then you kind of get into a new normal. And I think we're far enough into that new normal that it's appropriate to invest if it seems like investment is warranted. Don't get fooled by the lagging indicators, right? Like read into the leading ones. It's a moment to say, hey, if our business is still not really working, maybe it wasn't the market. But if our business does look like it's working, let's not slow pedal it anymore. Like this is what it's going to be. So if we're in the industry of creating growth, let's create that growth.
Yeah, totally. Yeah, it feels like a transition from defense back to offense again for companies that are lucky enough to see some opportunity in front of them. Question is, do you think we learned anything from this, the last few years? Because, from where I'm sitting, there's still a lot of pain out there. There's a lot of companies struggling. But on the flip side, there's also a lot that are like, ooh, we just are cranking up the hiring knob again. I just saw a deal get done. I won't mention names or firms or anything, but it was at a 38x multiple on a seed company, which is wild. I haven't seen that in a long time. But things like this are coming back, and for me, it's like, no way. Did we not learn anything?
Yeah, it's I feel like people learn. Maybe markets don't learn as well. It's kind of like this thing where when I started RJMetrics, my first company, I was working at Insight, loved it, great team, couldn't have asked for a better launching pad for becoming a founder. But I kind of the call of the wild called to me, right? Like I had to go and do it, and I quit my job at Insight on a Friday in September 2008. On Saturday, Lehman Brothers collapsed, and we went out.
I shouldn't laugh. That was probably scary.
It's set up to be laughed at. Yeah. My co-founder Jake and I, Jake also worked at Insight. We kind of found ourselves dropped into a market that was wildly different than we were anticipating, and we spent the latter part of 2008 and certainly 2009 and the better part of 2010 scrambling, bootstrapping, running like the leanest of lean startup methodologies, completely unable to raise capital, like kind of suffering for the sins that had been committed in the market the few years before we were actually in it. And I took a lot of learnings from that. And by the time we got into this cycle now, and a lot of people were saying, oh, it's like 2008 all over again, or even it's more like it's 2000, 2001 all over again. And I looked around and I looked at everybody, right? The other people at my company. I looked at the cap table of my company, the investors who had put money into the business. I looked at the customers and the average person that we were selling to and working with. And I was, above the 50th percentile in age. I am losing my hair and I've got the salt and pepper beard and I've got the kids that are growing up. And I'm at that point in my age where when I was at Insight and I saw a founder like me, it's like, oh, that's an old guy. It's one of these old people in tech that like kind of hang around for a long time. And because of that, I found myself in a lot of rooms where I was like the only one that was around in 2008, or at least the only one in the CEO seat in '08, like dealing with the problems that a founder has to deal with in '08. Like the chances that, founders that are better than me have, maybe wild exits and retire. Founders that are maybe less lucky than me decide to, pursue another path if they're not in the seat anymore. But like, how many people that are partners at VC firms in this last cycle were partners at VC firms in '08? Only the legendary, like best of the best, right? How many CEOs of growth stage venture backed companies right now were also CEOs of growth stage venture backed companies in '08? It's like very, very, very few. So like on the question of like, did we learn anything? Hell yeah, we learned a lot. But the we is a bunch of human beings that might not be running things by the time the next Black Swan event happens. And the question is like, how can the markets like take in this like learnings through osmosis, like passed down as it's almost like tribal knowledge, right, through generations, to make sure that we don't make the same mistakes again. And when you look at it in reality, like, look, we make the same mistakes again. And especially for investors have the benefit of being able to invest at that 38x multiple because it's kind of the risk profile that their LPs are actually seeking, right? Like, it's not like they're investing out of their own wallets. It's not like they're not part of a broader, they have their own portfolio. And then the people that invest in them have a portfolio that is even further diversified away from them. Like, you kind of want to like throw a couple of these flyers out in the chance that, you're investing in the next Meta or something at a very early stage. And like, if Peter Thiel wrote that check into Meta at a 38x multiple, he would have still done fine, right? And I think that we can kind of forgive the raw mathematical incentives of VC firms on. The problem is for the founders who, raise the money at that level and have stars in their eyes in that moment, or the FOMO of not taking the great deal, or the reality distortion field of thinking that their company is absolutely going to crush it no matter what, and any valuation is too low. When all those things kind of hit at the same time, you potentially find yourself taking on too much at too much value and like limiting your own options and regretting it a few years later. And again, like most of the people making those decisions have never been in that position before, and operate out of all kinds of cognitive biases and fear. And that's hard to counteract, right? You want really good boards and really good advisors and mentors and coaches around you to deal with it. Sorry, this is like I'm like on a soapbox here in response to your crazy question, but yeah, I mean that's what that invokes for me.
Yeah, no, I love it, and a lot of great points there. And one of the interesting things we're seeing too of like founders raising at these ridiculous valuations when they did is now we're in this time period where we have like a lot of unicorn plus companies, right? We have this big backup of companies wanting to IPO, and everyone's saying, 2024 is going to be this huge year of M&A. But I feel like what happened is because we did these huge monster rounds is that you cut off a lot of M&A targets. Even if you're crushing it, who's going to pay multiple billions for this company when, if you had maybe not pushed it as far, you could have some really interesting outcomes happening right now.
Yeah. I mean, I think the minor tweak on what you're saying that I'd add is like, it's not that you've cut off M&A targets, it's that you've cut off M&A targets that make any sense for the founders, right? And like, I think one of the things, this is going to be such an incredibly fascinating year. This is going to be like the Game of Thrones of years in like venture-backed company M&A, because ostensibly the IPO market is closed. Like will Databricks go out? Will Stripe go out? Maybe we'll see Reddit go out. Like, sure, we're talking like we can count the companies on one hand, right? And they are either some of the most absolutely incredibly financially performing companies that have existed in a generation, or they're companies that have been around forever, operating at really big scale, just kind of looking to like have a path to cleaner, consistent liquidity, or resolving cap table stuff that they want to resolve in some of those cases, right? So it's not like the glory days of the IPO market where you can, get to 100 million in sales and be growing, 40 to 60% and kind of make the math work. Those aren't going to go out. So the interesting thing becomes all these dynamics at once, which is investors, depending on the structure of their fund, this isn't true of every fund, but many investors start to get antsy around, they want to raise the next fund. They want to show demonstrated actual like cash returns to their LPs that aren't just represented on paper. Founders get tired, man. I can't tell you how many CEOs I've talked to in the last year or two who are just trying to find an off ramp and like afraid to admit it to their investors or even admit it to themselves, or they have admitted it to themselves and they're struggling to find a way to not be at the helm, but also not lose the whole thing or feel like they need to shut it down. And like, kind of the soft landing off ramp where maybe you pick up some stock in a company where the energy's there, the momentum is there a little better, and you have a slightly less demanding role where the whole world's not on your shoulders. Sounds really, really, really compelling to a lot of founders who burnt themselves, who got real giddy in 2020 and 2021, and like we're on top of the world, and then have had to break the hearts of their teams and themselves through multiple rounds of layoffs and corrections, and maybe realizing that the product market fit, they fell out of it or it was never there. And then they find themselves in this spot where they got to pick a path. And, the path of joining forces with some other company can be really, really compelling for a lot of it can be good. But then the question is, the deal economics of doing those things. We're going to see plenty of deals where companies get sold for less money than they raised, or they do it for stock at a somewhat fantastical theoretical valuation, or just a way of kind of sidestepping the hard truths of the like cash changing hands dollar values, and find a place for the team and a place for the tech, and hopefully create a better story. But all these things are going on at once, right? Like there's and I guess the other thing is just, and we'll get into ecosystem led growth a little bit, but you look at the changes in the way that people are buying products out there in the market, and this very interesting thing where people want to have their cake and eat it too. It stinks to be buying from 100 different vendors. How many ads did we see in the ZERP era of like, did you know your company, the average company has 2.7 SaaS tools for every employee, right? Like there were like 10 companies that got started at the same time to like help manage SaaS spend for a legitimate reason. Companies want to, buy from a fewer number of vendors, but they also want best in class solutions. Like they don't want to go back to the license and maintenance days and just buy everything from SAP soup to nuts, from, databases to sales to HR to everything else. Verticalized SaaS is here to stay. The idea of buying technology in stacks is here to stay. The key thing is these can't just be 200 silos. There's this deep mesh of interoperability between these tools that becomes really, really critical to like, some people buy products more because of how well they fit into the ecosystem of their existing tools than because of the actual feature functionality or user experience of the product itself. Like if software ate the world in the early 2000s, like ecosystems are eating software now. And that ends up becoming really, really important through the lens of M&A, because it is this interesting opportunity to do a bit of that, have your cake and eat it too, right? Where you're not relying on one singular kind of supernode entity to build products from scratch across all different personas and all different industries. But what you do have is an opportunity to combine extremely highly compatible technologies that would have normally been deeply partnered, and do it in a way where the business case actually makes sense and you get increased efficiencies out of it. But what that means is if you're not participating in an ecosystem, your off-ramp, your path to that exit is going to be severely compromised. The things that we see this year in M&A are either going to be very close partners with overlapping ICPs that already have deep integrations and overlapping customers, and consolidation among direct competitors. Like those are going to be the two big buckets. I don't think there's going to be a lot of uniquely like financially strategic style M&A out there, at least in the mid-market, right? PE firms are going to continue being active on the big publics, but I don't know. That it feels like there's a wave of that coming. Like we're already seeing. We saw Drift and Sales Loft. We saw Sendoso and Alice. For every one of those where we recognize the names, there's 20 more that have already happened. Where the LinkedIn post didn't get enough likes that we noticed it. But it's out there. It's out there
Yeah.
already.
They didn't buy the TechCrunch article and blow
Yeah,
it
that's
up.
right. The paid placement didn't
Yeah.
stick. Yeah.
Yeah. Well, that's a good transition. So I love this. Software was eating the world, and now ecosystems are eating software. I would agree with that wholeheartedly. And that's a good transition to this topic of ecosystem-led growth. We've talked about it before on the podcast, but I think your purview on this topic is second to none. And I have my own personal views that this idea of ecosystem-led growth, as it evolves and takes new form and shape, is going to be the future of how a lot of companies, SaaS companies, scale. Just like we had the predictable revenue model that we all used for a decade or more. I think the new playbook is being written, and you're at the forefront. But I guess let's start with just a definition of ecosystem-led growth. Like, what does that actually mean to you?
Yeah, to me, it really means applying playbooks that leverage the data and relationships that come from your partner ecosystem to grow your business faster. And it applies all the way up and down the funnel, right? This is demand gen, this is sales and co-selling, this is customer development, and it's the development of your ecosystem itself. But you said it really well earlier, which is, partnerships get a bad rap. There is a legacy of kind of baggage attached to the idea of partnerships where, whether deserved or not, enough people have had experiences with partner teams or partner professionals where it's kind of been, reduced down to a perception of, hugs and chugs at conferences and press releases around partnerships or integrations. And, occasionally, partner professionals kind of mucking around in people's sales deals and making them nervous. And, it kind of adds up to like this death by a thousand cuts perception that a lot of professionals in the revenue industry have, that like partnerships just kind of doesn't compute, right? Like it gets a lot of hype and attention, but it's not really carrying or delivering the quota. And that's especially on the side of like technology partnerships, product driven partnerships. Like we could spend time talking about the channel and, the history and interesting opportunities and challenges there. But, largely when people think partnerships in a modern SaaS context, because of the rise of the API economy, it's really the big investments that happen by creating a better together value proposition with some other technology company, which almost every, not even just SaaS company, right? Every tech company worth its weight in the vintage founded in the last 15 years has made a practice of doing. So the thing you said earlier that I loved is that all of that work, the creating of the connectivity and the storytelling and the theoretical value creation and shared value propositions, that work, everybody's doing it. The work that people are really starting to figure out that is ecosystem-led growth is how to take that asset that you have, that you've already invested in, that you're deciding to allocate energy to, and turn it into a lever to make your go-to-market teams more successful. Like ecosystem-led growth is about growth. It's not about growing your ecosystem. It's about growing your company. It's about generating a more direct product market fit. It's about the demand generation that comes out of that and that you can create from it. And it's about winning more deals, bigger deals, faster, by virtue of levering all that data and all those relationships. And it's there and ready and available. And the companies that have really, really figured it out are the ones that are benefiting the most from it.
Mm-hmm. For sure. I kind of look at it as, the natural evolution of a lot of the different trends we saw, where we saw kind of in the COVID era, this community-led growth motion. Everyone was talking about like community-led growth. And for my eyes, that is the idea of expanding networks. So getting more connectivity, getting more partners, getting in front of more people. And then we had kind of the PLG movement, where it was like, hey, we could give free value away to people in a lightweight piece of software, or even look at PLG as you could even create content assets that were providing value. And that was like, okay, we're providing value to the ecosystem now. And now this evolution of ecosystem-led growth is that transition from value to revenue, which has always been the hardest part. And part of the reason I think, you don't see that many partnerships professionals around like the C-suite, which they should be in my eyes. It's because they didn't have that big boy number for a long time that they could point at and be like, look at this. This is a huge part of our business. And I think particularly, you called it out, like mid-market SaaS companies hadn't figured out partnerships for a long time. And there was a few that did it pretty well. But it's exciting to see this transition. So let's start at the beginning. So we have a definition. Let's say I'm a early stage software company. I'm seeing some traction. I want to leverage some partners. What's the makeup of the partners I should first approach? Like, let's start at building that initial kind of relationships.
Yeah, I love looking at this not through the lens of what's going to benefit me or what what's going to be the right choice for my company. You've got to start with the buyer. Like, you've got to start with like an understanding of who your target user persona is. What's your ideal customer profile from kind of a company's target standpoint, and understanding how it is that they actually buy products and services. And what are the things that they evaluate and they prioritize in the course of doing that, and particularly in the category that you exist in. And the answer to which potential partners you might want to spend time investing in going to market with, or building product integrations with, or doing something more strategic with, should be one where you have a high level of confidence that there's going to be a deepening of your product market fit among that persona, among that ICP, by virtue of this partnership or collaboration existing. My perfect example of this is like my second company, Stitch. We were an ETL platform, so we competed with like Fivetran and Matillion. So if you're not a complete data nerd like me, basically we built data pipelines that would like suck data out of the APIs of all the SaaS tools we use and then deposit it into data warehouses for analytics like Snowflake or Amazon Redshift or Google BigQuery and the like. So in that world, when you really think about our buyer, you've got to ask like kind of the 5 whys of like, why are they buying our product again? And those whys, you couldn't even get 2 whys deep without a story that has to include a partner. Like, they likely are trying to build they're trying to answer some kind of question in their business, right? They're trying to make their business work better. And that question is probably being answered via a business intelligence tool, like let's say Looker. And then that business intelligence tool likely sits on top of a data warehouse like a Snowflake. And they need to run queries on that data, but the data they need isn't there. And who can get it there? Stitch can get it there, right? Like, we're the pipelines that'll dump the data in. Now, that's a really interesting story, because what I've just described is a stack of technologies, right? Of these best in class pieces, the Lookers, the BI piece, the Snowflakes, the data warehouse piece. Maybe you got a little DBT magic in the middle, helping you make those queries easier. And then you've got Stitch kind of moving the data in. Well, what's wild, and this is where ELG becomes so cool, is at Stitch, we were partnered with Snowflake. We were partnered with the DBT folks. We were partnered with Looker. But we didn't even have an integration into any of those except for Snowflake to drop the data in. But the value chain in the value story of our buyer just kept going across all these tools. And you want to know who our number one referrer of lead gen, not just in partnerships, across the entire business, in the entire life of Stitch, the number one source of new leads was Looker, a company that we didn't even integrate with. We didn't do a single thing. Like, the connection between us and Looker was this basically Snowflake as middleware. But the value chain that existed in how people were experiencing a job, they were solving a job to be done inside of their companies. It involved us, and it involved this like stack of technologies. And I don't care what industry you're in. I don't care if you're in, you're a vertical SaaS product in like the HR industry, or you sell into construction companies, or you're in a universe where you're in MarTech or sales tech. You can do this exercise, and you might realize really, really quickly that your go-to-market motion and the way in which an ecosystem that you participate in could influence it is not directly and exclusively correlated to the companies that you've spent thousands of dollars or hundreds of hours or whatever else building these like airtight custom bespoke integrations into. Like, the people have this idea in their mind that there's this J curve where you have to invest this incredible amount to do ecosystem building and build these direct integrations all before you can even start the exercise of doing the go-to-market work. With ELG, that's completely upside down. Like, the exercise of identifying who has overlapping customers with us, who has overlapping sales pipeline, who has overlapping target personas and prospect lists. You can do that work first. And in a lot of cases, you can do that work with companies where you can make their product better and they can make your product more essential, just by virtue of the fact that companies do better when they're using them both, even if the two products don't directly talk to one another. And it is incredible if you look at the universe of companies connected on Crossbeam, how many of them that's really true for. It's go-to-market alignment. It's making your customers more likely to win when they're consuming your products and or services together. Everything I just said could apply to services companies too, right? System integrators, agencies, et cetera, who bring these products to life side by side in a certain environment. It's not always the ones that are certified on your product. They might just be certified to install a product that works really nicely with yours, and suddenly they're kind of this major indirect channel for you as well. But that's where it gets really, really exciting to me, is that it is really specifically about the economic incentive systems that inherently exist for companies to try to make each other win, because the buyers are buying products differently. They are buying products in stacks. They're buying products based on what products they interoperate with or can coexist with. And if you can tell that story in a compelling way, integration or not, you can win more. And knowing who to tell what story to is why you use Crossbeam, right? To surface that precise data and knowledge about every single account.
Yeah. So there was a lot there, and you mentioned a few things, and I want to highlight them because I used to spend a lot of time thinking about this. Is this idea of kind of a value chain? And you mentioned two partners. There was Snowflake, and then there was Looker. And I think a lot of companies see, hey, we partnered with Snowflake, like the spigot's turning on. Everyone knows Snowflake. It's this big marquee brand, like watch the leads sort of pour in. And then maybe you look at a smaller company like Looker, not that they're a small company, but in comparison, and the overwhelming majority of value came from Looker. And what I think, and you described it as a value chain, I used to think of it as kind of this problem maturity of where each partner serves the buyer on their journey to solve a problem. Like, we both live in the go-to-market world, so typically you'll get like a CRM, and then you get an engagement solution, then you probably get an enablement solution, and there's like an order typically that buyers will mature at, and you need to understand that for your buyer, because oftentimes it will be the partner right before you that is going to derive the most value, and you need to find ways to push value back to them, because it might not be a direct like tit for tat, because you're actually driving more value to the next person in the maturity model, if that makes sense.
Yes, it makes a ton of sense. And I think there's like a linearity that does exist in nature, right? There's, even in the stack I just described, there's a very specific chain of command there, right? Like the data is literally flowing directionally from one end through these intermediaries to the final value deliverer. The thing Looker had as an awesome advantage was they were kind of at the top of that stack. So when someone experienced this incredible combined value proposition of the Stitch got the data right and dbt got the model right and Snowflake was performant in delivering the query, Looker was the one that delivered the chart that had the answer, and people are like, Looker's amazing. And that is a thing that is I think to be considered in the kind of the like formulary of how and where value gets realized by different people with different budgets, right? The person who says Looker is amazing might be the executive or the board members or the folks consuming it. The people that were buying Stitch were kind of more in the ops environment, right? And in a lot of cases, the people buying the data warehouse, if you were using Amazon Redshift, it probably came out of your AWS budget, and it was actually people in your engineering organization making that decision. And to them, it may not be in the boardroom, but there's high fives about how quick that Redshift query was, and it's something that's motivating a person with a budget for this to be a thing. So very, very, very important to understand this, quasi zero sum game of budgets, but also the fact that the joint win here is actually the thing that can pull your company's value prop from below the line to above the line. So, a lot of companies get stuck at the kids table kind of selling to small specific teams or, within kind of sub teams in a larger thing. But where we end up, helping people through ELG strategies is if you're part of a value chain, that does make it into that boardroom, even if it's not your product that's being directly tied to it, the reality is if you yank your product out, it's going to make that end thing less valuable or make it stop working entirely. And that is an incredible defensive moat. And it is something that is really, really important, especially in times like now where like churn and the ability to continuously expand accounts becomes really critical. You become part of this mesh where if you tug on your product or try to dial it down, it's going to actually cause a movement in all these other items. So while not everybody can be the looker at the top of the chain, the more you can participate in the mesh, the more you can find really specific persona-based champions for the thing that you particularly do well. And the more that you can create a moat against your stuff being removed because it fits into something bigger that matters, above the line at the senior most levels of the company, even if indirectly. And I think that's very, very different than, kind of an isolated, fully siloed point solution purchase, which is what I think a lot of SaaS was back in the ASP days, right? Like 15 years ago when we started RJ.
Mm-hmm. Yeah. Man, I could geek out on this topic for the next probably 3 hours with you. So we'll have to do this again, and we'll got to do some stuff in the newsletter because there's so much, and I truly could talk about this for a really long time. The good news is you are actually coming out with a book on this on March 12th, very simply called Ecosystem-Led Growth. I'm excited to check it out. So do go check it out. Again, that's March 12th. But I do want to spend a little bit of time talking about this story because I'm just curious. This $2.6 billion mistake. Tell me about it. Walk me through that time period.
So there's a reason that I used actually Stitch and Looker as my earlier example, and it was so I wouldn't have to explain a ton of backstory here because it actually involves those companies, right? So I've talked a little bit about that dynamic. RJMetrics predates all of that. RJMetrics is the company I started the day Lehman Brothers collapsed. And it was a all-in-one kind of one-stop suite solution to do data analytics in the cloud. So what that meant was we built a lot of technology at that company, but the idea was, hey, if you are Warby Parker or Casper Mattresses or some e-commerce like direct-to-consumer brand, here's what we can offer you. Sign up for RJMetrics, and all you have to do is put in your username and password for like your backend database. Like there weren't a lot of SaaS tools even to begin with back then. We will ingest all the data from your database. So we do the ETL stuff. We will house it in a database, analytics database, kind of predating the data warehouse world that we stand up and maintain. And it kind of lives in our, kind of private cloud. And then we provide you with a front end that allows you to do data modeling and also run queries and build charts and dashboards and share those dashboards with your team, right? So it was a full stack business intelligence solution. And in 2008, 2009, interestingly, we were like almost too early with that. Like we didn't have product market fit directly in the early years, except for extreme early adopters, because people weren't on the cloud. Not everybody had these cloud connected databases. Not everybody, the compute stuff was like really expensive and slow. Like we were standing up our own server farms in these like colos. Like AWS was not something that was able to handle this particular use case just yet. So we did all that work, and we kind of were grinding it out for the first 1 or 2 years. We bootstrapped the company to our first 100 customers, our first $1 million in revenue. And then by 2011, 2012, like SaaS happened and the market lit up and we slipped into product market fit in the most beautiful, incredible way. From late 2011 into like 2015, RJMetrics was like flying off the shelves. And we built a really substantial business there. And it was just like the right product at the right time for the right market. And we were able to really become like the dominant player, particularly within the e-commerce category for analytics. But we also had a ton of SaaS companies and gaming companies and services companies and random real life physical retail businesses started using it. We started diversifying out into all these verticals. And then in 2014-ish, Amazon Redshift, the big cloud-based data warehouse, started becoming like really mainstream. It became like the fastest growing product in Amazon's history. And it became the first wedge in what would eventually become the modern data stack, which is what I described earlier, right? Like the direct enemy of RJMetrics, which is like, if we were a one-size-fits-all suite solution, This was like, hey, why don't you compose the stack that you want? Your engineering team can get the database they want. They can have Redshift. Your ops team can get the data pipelines and everything that they want. They can use, whatever solutions they want to use for that, a Fivetran, a Stitch, or whatever. You can buy Tableau, you can buy Looker, you can buy Mode, you can buy Chartio, you could buy, Microsoft Power BI, whatever you want. Stick it on the top for your charts and dashboards. And in this moment, we looked at that emerging thing. We even got asked the question. There's an old TechCrunch article from one of our funding rounds, like, aren't you worried about Redshift? And I sound like an idiot. I give like the most wrong answer ever, which is like, we don't compete with Redshift. Like, Redshift is a cloud-based data warehouse being built by engineering teams. We're a full stack analytics solution being built by marketing teams. Like, when are we going to collide with this thing? Well, guess what? We did. We fell out of product market fit so fast in that business. And by late 2015, we'd gone from growing over 100% a year to, I think that year we grew like 8%, net. We had churn and contraction. We were still doing okay in e-com, but we basically completely lost the SaaS market, the gaming market, all of these kind of ancillary other spaces. There was a better tool for the job that showed up. And it was actually a direct result of a lot of the ELG stuff we were just talking about, right? The API economy had emerged and matured, and the ability to build these interoperable products where you can compose the pieces you want. It actually ends up costing less in a lot of cases, and it does a better job. And it gives everybody internally a sense of agency and power over product selections. And all those companies had ELG playbooks they could run with each other to cross-pollinate leads and kind of grow the value story together. And we were on an island. Like, we had an army of SDRs doing cold calls to generate demand gen. And like, that strategy stinks compared to the ELG stuff they were able to run. So we sold RJMetrics to Magento in 2016. And it was like, basically our later stage investors got their money back. Our early investors made some money. There was a little bit of money to go around, but it was like a meh kind of outcome. 2 years later, Looker sells to Google for $2.6 billion. Who got all the customers that we lost in SaaS and all the customers we lost in all that? Like, Google. They absolutely, by virtue of being at the top of that new ELG powered stack, they clobbered us. And it teaches a little bit of a lesson too, that like founders are always talking about product market fit, and they think like, okay, the market is where it is, and what I have control over is my product. And I can iterate on it and change it and build things for different people. I'm going to move my product around while the market is static. And then when those two things overlap, I have product market fit. What they don't tell you is that the market moves too. And I think what we did at RJ is we did that first phase and we found that product market fit, and then we stopped thinking about it. And in as little as 8 years, the market, and this happens in technology, look at AI right now, the market moves so incredibly quickly that we kind of stayed where we were the whole time. The market moved, and that's what brought us into product market fit. And then it continued moving, and that's what slipped us out. And I've kind of vowed to like never make that kind of mistake again. But it is something that weirdly was like, planted the germ of the idea behind Crossbeam and what could be with ELG, all that time 10 years ago.
Yeah. I was going to say, yeah, that feels like the catalyst behind the thinking of, fully embracing the ecosystem. Don't fight the ecosystem. You kind of tried that. It didn't work. Embrace this idea of ecosystem-led growth. And I've never had someone articulate the way you talked about product market fit, where it's not static, right? If the product is moving as well as the market is moving. So both of those things need to constantly be aligned. So just because you have product market fit today doesn't mean it happens tomorrow. I think that's a really good words of wisdom for founders out there listening. Well, awesome, man. This time absolutely flew by, but thank you for taking the time. You have so much knowledge, and appreciate you sharing it with the GTM community. I do want to highlight as well. So if this stuff is resonating, if you're a nerd like me and can't get enough of this kind of ecosystem-led growth concept, you are also doing ELG Con, so Ecosystem-Led Growth Con down in Austin, May 15th and 16th. So if this is resonating with you, go check that out. Austin, obviously such a fun city. I'll be heading there for South by Southwest pretty soon, which is always a good time. But Bob, thank you so much. Last thing, people are probably excited about Crossbeam right now. Are you hiring any key roles if people are out there looking right now?
Yeah, it's going to be a growth year for us for sure. Look, we hunkered down in 23, like just about every SaaS company on the planet. We've actually just made some hires on our go-to-market team. We've got a lot of exciting stuff happening. We just made some hires in product marketing. If you head over to just crossbeam.com, check out the careers page. We are certainly planning to add to the squad this year at long last after kind of holding steady for a good 12 or 18 months there with the rest of the SaaS universe. So it's an exciting time and would be awesome to add amazing folks to the team.
Amazing. Beautiful. And keep an eye out for more on this ecosystem-led growth topic. We're going to be partnering with the Crossbeam team on a lot of different things this year, because I really do think this is going to be the new model for scale. But thank you, Bob. And for all our listeners, thanks for hanging out with us. We appreciate you lending your eardrums to us for 45 minutes. And I always say it, but listening is one thing, executing is totally different. Take some of these things that we talked about, try and apply them to your specific business. And hope you have a great quarter. We'll see you next week.
Thanks, Scott. Really appreciate it. Cheers.
Thanks, man.